Hello. In this video, we're going to discuss the MACD, which sounds really fancy. It is an acronym for Moving Average Convergence Divergence. So it's really a very simple moving average cross type of strategy, type of indicator. So essentially, it is an indicator, and it's just measuring momentum, as most indicators are purely measuring momentum. So essentially, in that theory, if price is trending higher and momentum is starting to wane, that is starting to foretell that either you're going to enter a period of consolidation before another move higher or a trend reversal. So momentum is a really important thing to study. There's a lot of different ways to study it, and MACD is probably one of the more common charts or indicators, excuse me, that people will tend to have on their charts. A MACD is essentially three moving averages. What's typical is you use a 12, 26, and a 9. So 12 period, 26, and a 9 period. You can use anything you want, but that's kind of a typical. So if you load a MACD indicator on a chart, it's usually what is preset as the values of 12, 26, and 9. And what's also preset is exponential, meaning that the moving average is an exponential moving average. Which is different from a simple moving average or an SMA. In an SMA, all the periods, so if it's a 12, 20 period SMA, all of those 20 candles or 20 periods have an equal weight. In the case of an EMA or an exponential moving average, the more recent candles have a little bit higher weighting. So you'll tend to have a little bit more, the more recent candles will tend to move the moving average quicker in an EMA versus an SMA. So let's look at the main thing, and let's look at kind of what a MACD is all about. The main thing is this histogram. It's a really nice visual tool, but let's see what kind of makes up the histogram. In this case, I have a blue line, and that is the difference of the 12 and the 26 moving averages. And they can either be positive or they can start to dip negative. If it's positive, it means the fast, in this case, the 12 is greater than the 26. Once the 12 dips below the 26, then you'll see this blue line go below this zero line. So the zero line is the differentiator between red in the histogram and green. It's literally right here. So the blue line, when it's above here, is a positive value. When it's down here, it has a negative value. And again, that value just means the difference of the 26 and the 12. And then what you do is now you look at how does that difference compare to another moving average, in this case, an even faster moving average. So this is the 12-26 difference, and then this is a 9 period, this yellow line. And once the difference of the 12-26 crosses below the 9, you'll see the histogram start to go red. And the greater that distance becomes, the greater the histogram turns down, same color red, obviously, but it just starts to go deeper and deeper and deeper. And then when it starts to decrease, the histogram will start turning up. And you'll see actually some charts, this one's actually kind of cool, different shade of red, just so you know that the values are actually decreasing and starting to turn positive. The main way that you would use this is if once you have a cross, it typically indicates that price is going to start to trend lower. Here you kind of had a cross on like right around this candle, and price did in fact trend lower, not a whole lot. Kind of hard to trade specifically off of that, but it definitely did start to foretell you in a couple candles that price was starting to trend a little bit lower. And then here you have a change again. Now momentum more to the upside, or just gaining momentum, I should say. I shouldn't say the upside, just gaining momentum. And you start to put a decent move in. And then as you start to come over here, you can see you almost do like a double top, if you will, and momentum starting to kind of wane. So that's one way that you use a MACD. One of the, I think, more powerful ways is to try to get a sense if price is entering a period of consolidation or a trend change. So in the case of here, this is the spider, had a decent sell-off, and then now starting to enter what appears to be a period of consolidation. And that could just simply mean that now we're going to start to trend even lower once this consolidation is done, or we're going to trend trend higher, excuse me, a trend reversal. But here's what you want to look at. If you just look at these candles, you'll see that put a decent low in after two big sell-offs, kind of reverse a little bit, and then came in and put in a lower low. So this low is lower than that. 2 days later, put in another lower low, and then again another lower low. So price definitely was trending down. But look at what's happened with the MACD. It's actually starting to trend up. Or it's still negative, but it's less negative. So that's where you start to look for a divergence. So price is actually going lower, putting in lower lows, but these lower lows are showing weakening momentum. And that starts to foretell of something, again, either a period of consolidation like what ended up happening, or just a strong trend reversal. I mean, this could have actually, right here, just could have kept going. Instead, we've kind of got into a period of consolidation. So that is essentially the in a nutshell what the MACD is all about. It's a popular and powerful indicator. It's not the holy grail. You need to use it, maybe in conjunction with some other stuff to get a sense of kind of what's going on. But it's definitely a powerful tool, and I suggest you take a look at it. So on that note, I thank you for listening, and I wish you happy trading. Thanks, everyone.